Okay, let's just dive right into this. Welcome to our latest explainer, where we're taking a really fascinating look into the Islamic capital market. Now, if you've ever wondered how investors navigate the incredibly complex world of modern finance while still sticking to some pretty strict ethical and religious guidelines, you are absolutely in the right place. Today, we're unpacking the source material to really understand the invisible guardrails that are shaping literally billions of dollars in global investments right now. But, before we get totally bogged down in all the complex math and corporate screening rules, let's start with something super practical. What is the absolute easiest way to spot a Sharia investment scam? Seriously, I want you to think about this for a second. If someone approaches you out of the blue with this amazing Islamic investment opportunity, what is the #1 red flag that should immediately tell you to turn around and walk away?
The answer? Guaranteed fixed returns. This is absolutely crucial. Fundamental Islamic finance is built entirely on the concept of risk sharing. According to the source material, a core, non-negotiable rule is that capital should never be guaranteed. So if a so-called fund manager comes up to you promising a fixed, steady income, guaranteeing your principal investment, and then slapping an Islamic label on the whole thing, yeah, they're more than likely a scammer. They're just using fancy terminology to separate you from your money. True Sharia investments involve genuine, real-world business risk.
So here's our game plan for this explainer. First, the rules of Islamic investing. Second, we're asking, is any stock 100% halal? Third, we'll break down the Sharia benchmarks. Fourth, we'll look at the qualitative test. And finally, purifying your portfolio.
All right, let's jump straight into Section 1, Rules of Islamic Investing, starting with the core principles.
The absolute bedrock of Sharia compliance begins right here. First and foremost, there is absolutely no riba. That means zero interest. Lending and borrowing money just to charge interest on it is strictly off the table. Second, a company cannot be in the business of selling prohibited products. We're talking things like alcohol or pork. Instead, legitimate investments have to be structured around actual, real economic activity. We're talking about contracts based on active partnerships, straightforward sales and purchase agreements, or legitimate fee-for-service structures. It's all about tangible, shared enterprise rather than just passively making money off of money. Which brings us to Section 2. Is any stock 100% halal? Let's talk about expectation versus reality.
There is such a fascinating contrast between these two worlds. When you go out to eat or you buy some packaged food and you see a certification from a body like Jakim, the expectation is that the food is 100% halal, right? There is this rigid, step-by-step examination of literally every single ingredient. But the Sharia Advisory Council, or the SAC, the folks who oversee public companies, they're dealing with a completely different beast. There are over 1,000 companies listed on the exchange. And massive, modern corporations are messy. They have incredibly diverse revenue streams. They hold money in all sorts of various banks. They operate on a global scale. Because of this inherent, unavoidable complexity, the SAC recognizes that expecting absolute 100% purity from a massive conglomerate is basically impossible. So instead of demanding absolute perfection, they actually evaluate companies based on strictly acceptable thresholds.
And that leads us perfectly into Section 3, the Sharia benchmarks, and the quantitative math behind them.
Okay, so the first major quantitative rule we need to talk about is the 5% benchmark. This deals with things that are clearly, indisputably forbidden, stuff like commercial interest or revenue from selling alcohol. Now, because virtually no massive company can operate entirely without at least some incidental interest, maybe from a conventional bank account they just have to hold for daily operations, the SAC sets a very strict 5% limit. This means that any revenue derived from these clear prohibitions, like that incidental interest or maybe a corporate landlord collecting rent from a convenience store that happens to sell alcohol, it must account for less than 5% of the company's total revenue. If it crosses that 5% line, boom, the entire company is deemed non-compliant.
But the screening gets even more nuanced when we start looking at the gray areas. We also have a 20% benchmark for what's known as potentially non-compliant revenue. Think about a massive resort chain. While they offer perfectly legitimate lodging, right, they might also have a mini bar with non-certified food, or maybe conventional stockbroking arms attached to a much larger financial group. Because the core business itself is totally fine, but there's a mix of elements going on. The SAAC allows up to 20% of revenue to come from these gray area operations. Then we have to flip over and look at the balance sheet itself, which has two absolutely critical 33% rules. First, a company's cash that's placed in conventional interest-bearing banking cannot exceed 33% of its total assets. If a company keeps all its cash in an Islamic bank, Great, the ratio is 0. But if they use conventional banks, it's strictly capped at 1/3 of their total assets. And that exact same 33% limit applies to a company's debt from conventional banking over its total assets. Basically, if a company relies way too heavily on conventional interest-bearing debt just to keep its doors open, it completely fails the screening.
Moving on to Section 4, the qualitative test, where we see why the screening goes way beyond just the numbers.
The source material gives us this hilarious but super effective hypothetical example here. Imagine a company where their revenue from alcohol sales is tiny, like well below that strict 5% benchmark we just talked about. Financially speaking, they pass with flying colors. But the name of their flagship restaurant is Happy Happy Drink Drink Happy Happy Don't Drink Till You Die. Yeah. The professor points out that this is exactly where the qualitative test comes in. The Sharia Advisory Council doesn't just act like a giant calculator, they are the guardians of the market's integrity. A brand image that fundamentally promotes or glorifies activities that are incompatible with Islamic principles, it will absolutely fail the vibe check. Even if the math totally works out, if the brand damages the overall image of Sharia compliance, the SAC will reject them flat out.
Finally, we reach Section 5, purifying your portfolio, and what it means to actually cleanse your investments. This introduces us to the really important concept of purification. This source material spends some real time on this. Let's say you invest, and over time you gain awareness or hidayah, this sense of inner guidance that you want your investments to be completely clean. Or maybe the SAC updates its list, which they do every 6 months, and a company you already own suddenly crosses that 20% hotel revenue threshold and gets delisted. Well, purification is the ethical process of cleansing your portfolio. It means you acknowledge that the non-compliant revenue isn't actually rightfully yours to profit from, and you literally redirect that unacceptable revenue straight to charity.
So how exactly do you pull this off? Let's walk step by step through this cleansing checklist. Step 1. The SEC officially announces your stock is now non-compliant. Step 2. The standard best practice guidance is that you should sell the stock immediately. Now here's where it gets highly specific for your wallet. Step 3. You are absolutely allowed to keep your original principal investment and any profit the stock made up until the exact day it was declared non-compliant. That money is yours, fair and square. But Step 4, and here's the catch. What if you don't sell immediately and the stock price actually goes up after the announcement? That new post-announcement profit is considered entirely non-compliant. You cannot keep it, you have to calculate that specific excess amount and donate the whole thing to charity.
And that brings us to the end of our explainer today. As we've seen, the modern corporate world is pretty messy. There is rarely 100% absolute perfection, which is exactly why we rely on these 5%, 20%, and 33% benchmarks, those qualitative brand vibe checks, and ultimately, the personal responsibility of purification. It requires constant vigilance on your part. So I want to leave you with this final provocative thought to really challenge how you view your own investments. In a fundamentally imperfect market, is your portfolio as clean as your conscience? Take a hard look at where your money is sitting today and see if you can apply the rules we just explored. Thanks so much for learning with me today, and I'll see you in the next explainer.